Strap yourself in for a long show. It's quarterly Christmas again. This is Tesla Tidbits episode number 491 for January 31st, 2019, covering Tesla's fiscal year 2018 earnings call. This show is sponsored by my supporter Richard. If you're in the market for a Model S, X, or 3, please consider using his referral code. Ask your sales representative to use the code Richard174 or go direct to the web link ts.la/Richard174 for 6 free months of supercharging, or now 9 months if you make your order without ever having taken a test drive. The referral program is over on February 1st, so act now or miss out. As usual, I'm going to start out with the technicals out of the investor letter. The highlights are pretty simple here. Tesla posted its second straight quarter with significant profit, bringing home $139 million of GAAP net income. This actually could have been substantially better, but they were hit with a $54 million charge that obviously put a massive dent in the profit. Also very important, Tesla improved its cash on hand to $3.7 billion, an improvement of $718 million. This is a huge deal, as this is nearly all of the amount due to bondholders if nobody chose to convert to stock for that $920 million bond coming due. This was a big narrative from detractors that Tesla would have a large problem come March 1st. But with this massive increase of available cash, assuming no further accumulation, and assuming a complete payout of cash to bondholders, they'd only be $200 million less in the bank for the event. While it'd certainly be nice to have that money in the bank, it doesn't put the company in the precarious position that its detractors had been claiming. Also remember that they had a smaller bond come due in November, which put a dent of $230 million into that potential cash savings, or they'd have banked darn close to $1 billion for the quarter. The gross margin on Model 3, whether figured via GAAP or non-GAAP methods, remained at about 20%. For Model 3, again, labor hours dropped in Q4 by 20% compared to Q3. This is a total reduction in labor hours on the car by 65% in the second half of the year. This is outstanding news as it pertains to the elusive base level of the car. If, and this is a big if, they can manage the same reduction again, and looking to Elon's email that the base car at that time would cost $38,000 to produce, the base car will be feasible by the end of this quarter. But let's not be too quick to assume this one though, folks, as that is a massive assumption. More realistic is that they can knock out 10% this quarter, and then maybe 10% in Q2, then that should be enough to bring the base model of the car into modest profitability. Something to watch in Q1 will be what would ostensibly be a precipitous drop in Model 3 deliveries in the US. Production is being directed to fill European orders, and as a result, the US delivery folks will finally get a chance to catch their breath for a while. On the charging side of things, Tesla ended the year with about 12,000 superchargers in the wild at 1,421 locations. Bear in mind that the goal is to have doubled the capacity before the end of this year. To accomplish this, they'd need to have roughly 23,000 superchargers deployed. They have a lot of ground to cover to make that happen. Over to the lesser covered side of Tesla, and that's the energy division. The salient bit of this side of things is that Tesla Grohmann was at work developing a new manufacturing line for Powerwall and Powerpack to help spin up more production for those products. Tesla is aiming to double their energy storage business from just over 1 gigawatt hour in 2018 to more than 2 gigawatt hours in 2019. As to Solar Roof, it still appears to be slow going. Tesla says it will continue to install solar roofs at a slow pace to learn about the improvements it's made over time to the product, as well as to understand if the installation process is viable in areas with inclement weather. Alright, with all that out of the way, let's get to the best part of this show, and that's the earnings call itself. Let's lead off with Elon's opening comments about Model 3 and sales growth.
Last year was definitely the most challenging year in Tesla history, but also the most successful. Thanks to the incredible work of the Tesla team, Model 3 became the best-selling premium vehicle in the U.S. for 2018. And in fact, when considering battery electric vehicles, Tesla achieved an 80% market share of U.S. sales in last year. I think this point is perhaps not well appreciated. All other electric vehicles combined were 20% of sales in the U.S. in last year. So I think that's not bad. We also delivered almost as many vehicles last year as we did in all prior years combined, which is a tremendous achievement by the Tesla team. If you track Tesla vehicle production year over year, cumulative sales and deliveries year over year, it is about the cleanest exponential I've ever seen. We've basically almost doubled our fleet in every year. Every year we make as many cars as we did in all prior years. So this is a very unusual thing to see, especially for a large, complex manufactured object. I think it may be the fastest that a complex manufactured object is, like a car, has grown in history, or at least I'm not aware of anything that is faster. Martin, are you?
I'm not sure. I think Model T was a little bit slower, but I'm not 100% sure.
Okay. And we expect that exponential to continue. So with the deliveries this year being, even in the face of, if there's a global recession, even if there's a global recession, we're expecting deliveries this year to be about 50% higher than last year. And it could be a lot more than that. But even with tough economic times, to see 50% growth is pretty nutty.
So lots to unpack there. As I think we've already covered, essentially, Model 3 killed it. Model 3 was the best-selling premium vehicle in the U.S. for 2018, bar none. Not just EVs, all cars. Very, very cool stuff there indeed. As the aforementioned EV market, Tesla as a whole owned 80% of the EV market in the U.S. Stop to take a moment and appreciate that one too. 4 out of every 5 EVs purchased was a Tesla. That's an amazing market share. This, of course, can't last as new players join the game, but right now, that's just stupidly good. As I'd also covered previously, Tesla nearly eclipsed the mark of producing more cars in 2018 than had ever been produced by Tesla in all preceding years. They fell just short, but that's amazing growth nonetheless. Elon ended his Model 3 remarks noting that despite an expected economic downturn in 2019, Tesla still expects to sell 50% more cars in 2019 than 2018. Given that the cars will be shipping globally, this isn't an unreasonable position to hold. The dam is about to break for demand in the rest of the world as deliveries begin outside North America. So just satisfying reservation holders alone will keep Tesla busy for some time worldwide. But what about that standard range model, huh? Well, we've got some news here too.
We expect to introduce the standard range Model 3, sometime probably in the middle of this year, is a rough guess.
It's certainly good that they're still targeting the release of the standard range model for the middle of the year. Really looking forward to that being released, as it's literally the raison d'etre of the car. But if you're looking to lease Model 3, well, I've got some bad news for you. I wouldn't be holding my breath if I were you.
Well, we've been reluctant to introduce the leasing on Model 3 because of its effect on GAAP financials. So it is worth noting that our demand to date is with zero leasing. So obviously leasing is a way to improve demand, but it has it makes our financials look worse. So we've not wanted to introduce that right away. We'll introduce it sometime later this year probably.
So in light of the effect of leasing on financials, let's hear a little now about Elon's take on the financials.
With Q4, we achieved GAAP profitability for the second quarter for the first time in company history, and we increased our cash on hand by more than $700 million, even after paying debt, ending the year with a total of $3.7 billion in cash. This means we have enough cash to settle our convertible bond that will mature in March. In addition, our operating margin remains strong at 5.7%. Operating margins in the fourth quarter are usually lower in the automotive industry, but this was not the case for Tesla. 2019 is going to be an amazing year for Tesla. As I mentioned, we're expecting to increase sales by 50%. Perhaps could be a lot more than 50%, but I think 50% is a very reasonable number. But that's crazy growth for the automotive industry.
So good stuff there, but what can we expect from Q1? Well, Elon is quite optimistic here in my book, to be sure.
I would say at this point I'm optimistic about being profitable in Q1. Not by a lot, but I'm optimistic about being profitable in Q1.
I am not nearly as optimistic as Elon here. Between what looks to be a roughly $900 million hit that they'll take to repay bonds, and another significant hit that they'll take due to severance and restructuring charges related to the layoffs in Q1, I think it'll be nothing short of a miracle if they're profitable in Q1. Next up, though, Elon speaks to service. Of particular note is some new functionality related to the car signaling for help itself.
And we increased our mobile service fleet to 411 vehicles. Mobile service fleet is something we can scale up very rapidly because we don't need bricks and mortar. We can get more vehicles, hire people, and deploy rapidly. It also actually results in higher customer satisfaction because we can actually send one of our service vans to your work or home and fix the car without you having to bring it into the service center or do any paperwork or anything like that. It's really seamless and visible. The customers love it. And we're also increasing the functionality of the Tesla app for service, so that instead of having to make an appointment, to call and make an appointment, you can just open your Tesla app, say you want to make a service appointment, and it lists the top 10 most frequently requested service items, and you can, with a couple taps, you've made your service appointment. And we're going to make it easier for the car to be picked up and dropped off as well. So if you prefer not to come into the service center at all, you can just request that the car be picked up and delivered. That's something that will be so that's already been rolled out. It's had a big improvement in customer satisfaction. That rolled out 2 or 3 weeks ago. The next thing we want to add is if a car detects something wrong, like a flat tire or a drive unit failure, that before the car has even come to a halt, there is a tow truck and a service loaner on the way. So the car has already notified Tesla Emergency Services, and a service loaner, a tow truck, are on their way before your car has even come to a stop. This will be immense in improving customer happiness. Literally, you'll just call it, and you'll have to tap the center screen to cancel it. So you can cancel it if you want. We just have to. It's like automatically going to happen. Let's press cancel.
Loving that auto call for help idea. If you're unfortunate enough to have a drive unit or some other major failure, not having to worry about making a call for help is a very nice touch and adds to the premium nature of the brand. Building on this, next up is discussion on the improvement of parts availability that will definitely help in the customer satisfaction department for folks that have managed to smash up their Tesla.
We're also improving parts distribution. So I think we made a strategic error in the past about not having service parts located at our service centers. We had them in parts distribution warehouses, which basically meant it was impossible to have a fast turnaround on servicing a car. Because the car would come in, then the parts would be requested, they'd come to the service center. This would basically, even for a very simple repair, could take days. So we're going to move to stocking all common parts at the service centers, so that it's possible to, in principle, have get your car serviced in 20 minutes or 15 minutes, even if it's a simple matter. It should be like Jiffy Lube, like 8 minutes or whatever, 8.5. It should be like lightning fast. But in order to do that, we have to have the parts located at our service centers. It's going to make sense for our service centers to do basic body work, or essentially if all we do is replace a front or rear fascia, it makes sense to just pre-stock the front and rear fascia in the common colors. So unless you have an unusual color, we can literally replace your fascia in 15, 20 minutes. And there's none of this like weeks at a body shop stuff.
All right, now onto the fun stuff. Let's talk Model Y and pickup.
In terms of new products, with Model Y, we've completed engineering of and design of Model Y, and the parts are the tooling is going out for production Model Y. 3/4 of the Model Y is common with the Model 3, so it's a much lower capex per vehicle than the Model 3, and the risk is also quite low. this is in contrast to Model S versus Model X, where the theory was in Model X it's I would consider Model X to be like the sort of like the Fabergé egg of cars. It's an incredible vehicle, and probably nothing like it will ever be made again, and maybe it shouldn't. but it is a work of art. It's a special work of art. But the commonality with the Model S is limited. It was only about maybe 30% in common with the Model S, whereas Model Y is I think 76% or something like that in common with the Model 3. And we're most likely going to put Model Y production right next to, in fact, as part of our main Gigafactory in Nevada. So it'll just be right there. Batteries and powertrains will come out and go straight into the vehicle. So that's also reduces our risk of execution and reduces the cost of having to transfer parts from California to Nevada. So it's not a for sure thing, but it's quite likely, and that's our default plan. In terms of the, probably there's like initial production of Model Y in very low volume early next year. But then it always takes time to ramp up any production system, and that's difficult to predict the shape of that S-curve. So, we feel confident saying like, there'll be volume production of Model Y by the end of next year, but in between the beginning of next year with low volume, it always starts with very low and it grows exponentially. And then the Tesla pickup truck, we might be ready to unveil that this summer. It'll be something quite unique, not like anything else.
So Model Y engineering and design is complete. This means we're on track for the sort of placeholder date that Elon gave out of March 15th for the unveil. Can't wait to see this one, as this will likely be my wife's next car. Learning from Model S to Model X, and I suspect sealing one of my bold predictions as true, Model Y will have much in common with Model 3, sharing 76% of its part list. Sorry, Falcon Wing fans, you'll need a Model X for this. And no need for a new factory. As expected, Model Y will likely be produced at Gigafactory 1. And speaking of that production, Elon sounds as though he believes that production will start at the beginning of 2020, and then I'd probably expect a similar ramp to Model 3 following that. And of course, we can't forget the pickup. That they're potentially ready for an unveil in the summer is astounding. I think they want to let Model Y simmer for a bit first, as I think the demand for the pickup will surprise even Tesla. Think about it for a moment. All the advantages of a pickup without the disadvantages of the gas mileage and maintenance penalties associated with a big machine like that. Sign me up. Moving onward, let's hear a little about autopilots, present and future.
Well, we already have full self-driving capability on highway. So from highway on-ramp to highway exit, including passing cars and going from one highway interchange to another, the full self-driving capability is there. In a few weeks, we'll be pushing an update that will allow the option of removing stalk confirm in markets where regulators approve it, which we believe that will be the case in the U.S., for example. And over time, we think probably all regulators will approve it. But we kept the stalk confirm there just to make sure that we took care of any strange corner cases. And it's really quite sublime if you have stalk confirm off and the car goes from highway on ramp, passes slower cars, takes an interchange and then takes the exit and then comes to a stop after the exit. So it's really quite profound to have that experience. Then the next part of full self-driving would really be is traffic lights is hard. So stop streets are pretty easy because you can essentially geocode those, and it's easy to recognize stop signs. Traffic lights and intersections will be the next really tricky one, and then navigating complex parking lots and if you're underground in a mall parking lot with a lot of traffic and pedestrians and it's on multiple levels, that kind of thing is where things get tricky. With the release of enhanced or advanced summon, you'll see the first indications of the car being able to navigate complex parking lots. And that's also coming out fairly soon, probably next month. And in development mode, the car does all of the things that I just mentioned in development mode. So it recognizes traffic lights and stop signs, and you could basically has all the functionality in development mode. It's really just a question of getting the reliability of recognizing traffic lights to several nines. So it's maybe it's like, I don't know, 98% good right now, but we need it to be like 99.999. Really extremely reliable. So I mean, in a nutshell, when do we think the capability will be there for? When will we think it's safe for full self-driving? It's probably towards the end of this year, and then it's up to regulators to decide when they want to approve that.
So Nav on Autopilot will gain the option to just handle itself without input in the next few weeks, though we must always remember Elon time. Also neat to hear that in development mode, the cars are already handling much of the more advanced tasks of full self-driving. But as is always the case with this self-driving technology, they need more time to get the system reliable enough for public consumption. Elon is guessing that by the end of 2019 it will be here, but again, Elon time, and also time for regulators to digest the advancement of technology. But that wasn't it. In response to a later question, Elon drives home just how vast he believes the gap is in the data that Tesla gets for its self-driving versus competitors.
We feel confident about our technical strategy, and I think we have an advantage that no one else has, which is that we have at this point something on the order of 300,000 vehicles on the roads with a 360-degree camera sensor suite, radar, ultrasonics, always connected, uploads, essentially video clips with the customer's information when there's an intervention. So effectively, we have a massive training fleet. The miles of training that we have, if you added everyone else up combined, they're probably 5%, I'm being generous, of the miles that Tesla has. And this difference is increasing. A year from now, we'll probably, if you go 18 months from now, we'll probably have 1 million vehicles on the road with that are, and every time the customers drive the car, they're training the systems to be better. I'm just not sure how anyone competes with that.
And I'm not either. While Tesla may seemingly be behind in the current race to full autonomy, when it comes time to flip the switch, I suspect they slingshot past all their competitors that are using more technology and more expensive technology to do the same thing. The last thing of note on the call is the now second retirement of CFO Deepak Ahuja. He's being replaced by Zach Kirkhorn, who has been with Tesla for 9 years. Elon mentioned that this tenure has made him a known quantity, and that this tenure translates to already having the respect of the various teams at the company. We'll look forward to hearing him on the next earnings call in a few months. And that'll do it for Tesla's 2018. Heck of a year, outstanding growth, and more yet to come. I feel like 2019 will be a little bit of a lull type of year, while the tail end of Model 3 launch wraps up. But 2020 should see at least the launch of Model Y, and then we'll be back at this all over again. That's it for today's show. Before I go, let me take a moment to tell you about show sponsor Foam Daddy. Foam Daddy is a nationwide company in the U.S. that sells and rents foam and snow machines. They are also proud to announce the arrival of the Real Snow Machine. This allows anyone to produce real snow in any temperature. Check them out at foamdaddy.com. My many thanks as well to our super patrons supporting the show at the $10 plus level at patreon.com/Tesla Tidbits. They are John Waltauer, Drew Schuyler, John Waller, Ryan Scarborough, Lee Sweet, William Henry Crew III, Dorian Steve Guberman, Bruno Kundichi, Joey Boots, Ralph and Cheryl Waterhouse, Adam Raymer Brown, Megawatt Photovoltaic Development, Todd Sullivan, Robert Healy, Mitch Long, Zortec LED Canada, Morven Ogg, Blake Thompson, Raymond and Deborah Malkowitz, T Sportline, Michael Pastroni, Travis and Cheyenne Rush, Cookie UK, Chris Hovis, Craig Murphy, and Vicky Kirk. If you have feedback for me, the best way to be heard is to tweet at Tesla Tidbits and use the hashtag AskTeslaTidbits if you'd like your question to be considered for the show. I'll see everyone back here again on Friday. Until then, keep it charged and hit the road.